Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 12th of December. I'm Daniel Lam, your host for the podcast. The global macro data has been a tale of two contrasts. Yesterday, we spoke about how the latest set of US NFP has been stronger than expectations, and therefore it may delay the timing of potential Fed rate cuts. And then we got the latest Chinese CPI and PPI data, which were worse than expectations, adding to fears about deflation in China. In fact, I had a radio interview yesterday, and it was very much about this deflationary concern. So it would be a great idea to dig deeper into this issue in this podcast. The main issue here is that price deflation is coming with high debt levels and falling real estate prices. So this in turn is triggering debt deflation and balance sheet recession dynamics. Now, in a nutshell, balance sheet recession is where companies choose to pay down their debt instead of investing in profitable projects. Now, central banks may try to stimulate by slashing the interest rate, i.e. doing monetary stimulus, but this may not be so effective if companies' main priority is to play defense. Now, China has been relaxing both monetary and fiscal policies since the second half of 2021. Now, this is so far enough to keep the economy afloat, but more is required to lead to asset price reflation. Now, monetary policy may not be so effective, because if you look at, let's say, the 3-month SHIBOR rate, which is a de facto benchmark rate in China, that cannot go significantly lower, because the authorities would need to balance stimulating the economy and preventing excessive weakening in the CNY. Now, on the fiscal front, the authorities have been trying to reduce credit and property market excesses, but the adjustment is not so complete yet. The demand side still needs to be worked on in order to stabilize property prices, which would eventually trickle down to recovery in consumer spending for the economy. That said, there has been some green shoots on the technical front in the Hang Seng Index. For example, on the weekly chart, one would notice that over the last 3 weeks, there has been significant jump in turnover at the time when the index had fallen from over 22,000 at the beginning of the year to the current 16,000. High volume of turnover when the index had already fallen by such an amount is a classic sign of capitulation. Stocks going from weaker hands to new, stronger hands. Thus, we believe there could be technical rebound in the Hang Seng Index in place to the area around 17,500 to 18,000. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.